What's up, everybody? Gen X Dividend Investor here. In this episode, I'm going to explain why I believe the ongoing population decline we're already seeing in many parts of the world will create upward pricing pressure on dividend-paying stocks, and why that could be a long-term tailwind for income-focused investors. I'll also talk a bit about where I stand on politics, which is stuff I usually don't get into, but someone asked me recently, so I figured I'd share. Then I'll answer a question someone asked me about whether you should be investing in good dividend stocks if you're in debt, and I'll respond to someone who said dividends are pointless for 99% of people. Finally, I'll end things with some of Warren Buffett's advice he gave at this year's annual Berkshire Hathaway conference, which is also when he announced his retirement. So buckle up, I think you'll enjoy this episode, and feel free to use the timestamps on screen if you want. Okay, so let's start with talking about population decline, and then I'll explain why I think it'll be beneficial for dividend stocks. Take a look at this animation showing population trends by region. It starts with historical data from 1950 until today, and then projects forward another 75 years. At first glance, it looks like the population has been increasing and continues to increase everywhere around the world. But around 2020, the population started declining in Europe, and in some places it's been falling pretty darn fast. Like Japan's population is declining by about 100 people per hour, which their government has deemed a crisis. Populations in China, Germany, and the Russian Federation are collectively projected to decline by 14% over the next 3 decades. And this data shows countries losing population the fastest from 2022 to 2023, with Ukraine being the worst for obvious reasons. But we also see that Greece lost over 1.5% of their population in that short time span, along with several others that experienced net decreases as well. Now, Ukraine is a special case due to the war, but generally what's happening is that higher income countries are seeing a slowing of population growth or even a decline of it, while lower income countries are still growing rapidly. A key driver of population slowdown is due to fertility rates, which have fallen sharply in Europe, America, and East Asia. Fertility rates refer to the average number of children a woman is expected to have over her lifetime, and we measure it using something called the total fertility rate, or TFR. A TFR of about 2.1 births is considered the replacement level in most developed countries in order to keep the population at least going sideways. So if a country's TFR is above 2.1, then its population tends to grow, unless it's offset by unexpectedly high mortality or emigration. If the TFR is below 2.1, the population tends to shrink unless boosted by immigration. Check out these fertility rates for various countries, and you can see how decades ago fertility rates were much higher, but then things have been trending down, and in some places they're below the replacement rate, so their populations are now decreasing. Apparently, as countries transitioned from being primarily rural, agricultural societies to more industrialized, service-based economies, fertility rates dropped sharply. Women began delaying childbirth and choosing to have fewer children. The shift was driven by a stronger focus on careers, sometimes out of personal ambition, and sometimes due to rising costs of raising a family. In many cases, people simply decided that having children wasn't a priority in their life goals. And stick with me as I'll explain in a moment why these trends support the case for dividend stocks getting more love. Another interesting phenomenon, which is actually pushing back against population decline, is that we are now seeing people live longer on average. In fact, the number of people over age 80 is expected to double in many countries within the next 25 years, and shortly after that, it's expected that people over age 65 will outnumber people under age 18. And now more people are predicting that life expectancy could materially increase even more over a relatively short time frame as improvements in AI drive healthcare. I personally wouldn't be surprised to see a future where real-time monitoring of every aspect of our biology, like our blood, cells, and organs, is standard. A world where dynamic healing and regeneration is possible, whether through advanced cell reprogramming, nanobots, or some Star Trek-level innovation. Illness and injury wouldn't be feared, but instantly understood and rapidly repaired. So whether that happens in 20 years or 50, I'm confident it will happen. Regardless, the changing demographics we're experiencing is a pretty big deal. I mean, seeing population decline in 63 countries, along with having a much larger elderly population, will all bring a bunch of new economic challenges our way. For example, the aging elderly folks will need more support from younger generations, at least until healthcare materially improves, and yet there'll be less young folks to help out, relatively speaking. And less young people also means less workers holding jobs to grow economies. Now, I imagine that robots and automation will help fill some of the labor gaps, but that too comes with major implications for jobs and the overall market. And of course, a lot of this is just estimates based on current trends and demographics and such, so you never know where things will really go. Right now, they predict that the US population is projected to reach a high of nearly 370 million people in 2080 before we start trending down. But China, currently one of the world's most populous countries with 1.4 billion people, is projected to lose 2/3 of its population by the end of the century, which is a dramatic decline. Their sudden drop is attributed to the one-child policy that they had prior to 2016. And I mentioned how Japan is losing its population quickly, and in fact, it's expected to be at 1/2 its current population before the end of the century. So what things are countries doing to try to change the net population decline that they're experiencing? Well, Italy has offered to sell homes in some of their small towns and villages for as little as €1 on the condition that buyers renovate them. This not only encourages population growth, but also helps revitalize local economies. Ireland offers grants up to €84,000 to individuals willing to refurbish and reside in vacant homes on its coastal islands in hopes of boosting its population in remote areas. The village of Albinen in Switzerland offers something like $30,000 equivalent per adult and about $10,000 per child to families under the age of 45 who commit to living there for at least 10 years. Greece is offering new residents of one of their islands not only a new home and land, but also will pay you something like $550 a month for 3 years to repopulate the place. And then similar sorts of programs exist in Japan, South America, and actually lots of places around the world. Like several US cities offer a variety of incentives to get people to move there and revitalize their communities. For example, Elwood, Nebraska incentivizes potential residents with free land to build a home, along with down payment assistance and a potential 10% payment of construction costs up to $25,000. Or Morgantown, West Virginia will pay you $12,000 cash to move in, amongst other things, if you meet their requirements. And there are a bunch of others out there beyond those. So bottom line, we are living longer, and to quote my late grandmother, we aren't being as frisky as we need to be. But why do I think that's a positive for dividend stocks? Well, one big reason is because slower economic growth should favor value-based dividend stocks over growth stocks. Dividend stocks tend to come from mature, stable companies with reliable cash flows. In a low growth or shrinking population, economic expansion will probably slow, and growth stocks, which rely on rapid revenue increases, may struggle, while value and dividend-paying stocks probably become more attractive to investors seeking stability and income. Plus, it's well known that older investors tend to value income stocks more than young people, which usually seek pure growth. Retirees typically shift their portfolios toward income-generating investments, such as dividend stocks, to fund living expenses. Basically, as people retire, they often move from accumulating wealth to living off it. Dividend income becomes a natural fit for this transition, reducing the need to sell assets. And thus, the demographic shift of more older generations should boost demand and valuations for dividend-paying equities. Another reason I think dividend stocks will do well is because slower economies usually don't need as much big spending on new projects. When population growth slows down or even turns negative, then there's just less demand for things like new factories, office buildings, or infrastructure. That means companies aren't pouring as much money into expansion, and instead they're more likely to return profits to shareholders, usually through buybacks and dividends. Also, when the economy grows more slowly, stock prices don't tend to rise as quickly. And since a shrinking population usually means slower overall economic growth, that can lead to smaller gains from just buying and holding stocks. In other words, if stock prices aren't climbing as much, investors might start looking towards more steady income, like dividends, as a better way to earn returns. And as we have fewer young, risk-tolerant investors, markets will probably see a shift in favor of lower volatility income-generating stocks, like those with consistent dividends. On top of that, I think the remaining pension systems will come under more pressure as people live longer and stay retired for more years. That puts a strain on their finances. And because of that, I can see institutional investors who manage these pension funds starting to favor dividend-paying stocks. Stocks that provide a more reliable income stream, which helps them meet their long-term payout obligations without having to take on too much risk. I could also see a greater cultural shift happening towards financial independence as life expectancy rises and birth rates fall. And that will lead towards people who put a greater emphasis on an income-based strategy for retirement as the fear of selling all their assets increases. I'd also expect that defensive sectors will gain relative strength. Many dividend stocks are in defensive sectors like utilities, consumer staples, telecoms, etc., and they tend to hold up well in stagnant or declining economies. Those sectors may become relatively more stable and attractive as other industries and sectors face headwinds from falling demand. And all of that could cause central banks to try to drive down interest rates. Population decline can lead to deflationary pressures and subdued economic activity, prompting central banks to keep interest rates lower. And when interest rates are low, then yield-seeking investors often turn to dividend stocks for better returns than bonds or savings accounts, further increasing their demand. I'd also expect governments to come under pressure to adjust tax policies in ways that further encourage long-term investing and support income generation. The goal would be to ease the burden on public retirement systems, and that could include giving dividend income more favorable tax treatment. And as automation and robotics improves corporate efficiencies, that will also improve corporate margins. So even with shrinking workforces, automation and productivity gains could boost corporate profits, leading to higher free cash flow and stronger dividend payouts. Thus, I think the future, which will be bumpy, will probably also get continually brighter for us dividend investors. Leave me a comment with your thoughts on all that, and as I love hearing from my subscribers. Okay, now let's switch gears and I'll answer a question about investing in debt, then I'll share some stuff about my political stance, and I'll end things with some final advice that Warren Buffett just gave at the annual Berkshire Hathaway conference. And the question I'm talking about is if someone should invest even if they're in debt. Now that's hard to answer without knowing more information about someone, not to mention that I'm just some rando on the internet who isn't a financial professional. But what I will say is that investing while carrying a lot of debt is probably too risky, though whether or not you should invest depends on your situation. Like if your debt has high interest rates, like credit card debt often has, then you're usually better off to pay it off first, since it's unlikely you'll earn more than that consistently in the market, and if you start missing payments, then your credit rating can get nailed. However, if your debt has a fixed low interest rate, then investing can make more sense, depending on your probable returns and risk tolerances and such. That being said, before you invest, I generally recommend having 3 to 6 months of living expenses saved up in case something comes out of the blue. You want a financial cushion in place in order to decrease the odds that you have to sell your stocks, potentially at a loss, if you need to come up with some cash. And then something else you might want to consider is your stress levels. I mean, if carrying debt while investing would keep you up at night, then it might be better to focus on paying it off first. I took on a 30-year fixed mortgage at 2.6% rather than paying it off with proceeds from my previous home sale because I was confident I could earn better returns over the long run by investing in solid dividend stocks. But some people might choose to pay off their house if they could and then invest because not having mortgage debt hanging over their head might really improve their mental state, and doing that is fine too. Now, if you do have some debt but your employer offers a 401k match, then that might be worth considering since matches are kind of like free money, but you have to weigh your personal situation to determine what makes most sense for you. I've sometimes gotten comments from people who say their plan is to invest into super high yield tickers and then use that to pay off their debt, but that can be quite risky depending on the details. I've seen how debt can slowly drown people, so be careful with whatever you choose. I'm big on slow and steady investing to get good returns over the long run, and I try to shy away from get-rich-quick things. That doesn't mean what I'm doing is what you should do, as everyone has their own path to take and their own perspective on things. Like I just got a comment that goes, "Dividends are irrelevant for 99% of folks though, unless you have a huge portfolio, it's not worth it." So I get his probable point that the income you generate from a small portfolio isn't anything to write home about, but I also think he's missing the forest for the trees. What I mean is that big things can compound from quality little things, if you give them enough time, and the same is true for dividends, even from small portfolios. Investing is like eating right or working out. You won't see results right away, but if you stay consistent, don't give up, get back on the horse if you fall off, and keep pushing yourself forward, then your results will probably be awesome as the years go by. But let's do a quick example to highlight what I mean. Let's pretend you have a relatively small amount to invest, like $5,000, and let's say you invest that in some stocks in a Roth account with an average weighted starting yield of 4%, a 5% dividend growth rate, and a 6% average stock appreciation, plus let's assume a 3.3% inflation rate. That gives us about a 10% nominal annualized return or a 6.7% effective annualized return when we account for inflation. I put those numbers into a tool I created. This shows you the inflation adjusted returns over time, so basically what your buying power would be like relative to now. So initially your investment would be yielding $200 a year in dividends. That isn't a lot, but it's still something. By year 10, if you had been reinvesting your dividends, then your portfolio would be worth about $9,000 adjusted back to today's money. By year 30, your portfolio would be about $30,000, and it would be yielding $884 a year in today's buying power. Clearly, dividends aren't a get-rich-quick scheme, but they are a path that you can use to do quite well over time, and even small amounts aren't irrelevant, especially when you factor in compounding in time and quality tickers that keep growing. And if you invest intelligently for decades, then dividends definitely can help you retire early, and if you actually contribute money consistently along that way, then they can become even more impactful. Of course, total returns are often where you should focus if your goal is long-term growth, and dividends are a key facet of what you want to consider. Again, even small amounts can turn into big results. It's kind of like eating 100 less calories every day. Yes, after 10 days, nothing is noticeably changed because 1,000 calories less is like what, a third of a pound? But over the course of a year, that's 10 pounds, something you definitely notice. So those things you think are irrelevant really aren't that irrelevant if you think about it. But I get your point. Now, I still think that most people will do best if they just invest in a broad market ETF like VU or VTI, and then if they really want to invest in single stocks, they can do that as well, dividends or not. As you get closer to retirement, I feel like it's a no-brainer to focus on dividend stocks, at least for people who really like the true passive income that dividends give you. I'm super grateful that I have a portfolio of dividend stocks that my kids will eventually inherit, and I'm glad that the income should flow in without them having to know anything about the market. To me, it makes all the sense in the world why retirees prefer passive dividend income, because the older you get, the more you value your time remaining, and so not having to deal with the stress and time of selling stocks has been truly amazing to me, which ties into the points I made earlier. Hopefully that all makes sense. Okay, now let's move into a new topic, and I'll share my stance on politics, as that's something I was recently asked, but which I tend to avoid talking about. Like on my Dividend Discord, I have a rule of no politics, unless it's directly related to investing and it's done in an unbiased way. A few years ago, I didn't have that rule in place, and things got toxic in the chat super quickly, so I've shied away from social media and politics ever since then. Anyway, I consider myself a moderate, a centrist, and am someone who finds fault with key elements of both major political parties. Too often it feels like each side is more focused on pleasing wealthy donors than generally serving the needs of everyday Americans, despite their claims to the contrary. Plus, I've not seen either party treat the debt seriously over an extended period of time, and we've been on a debt-fueled path that I fear could materially harm our country unless appropriately addressed. And even though I've shied away from talking about my personal politics, I've still had people from both parties flame me for various things. Like I've had people on the left that freak out at me because I invest in oil and gas stocks along with sim stocks. I've had people on the right that freaked out at me when I talk about things like wealth inequality or raising taxes on the super rich, which both Warren Buffett and Jamie Dimon have publicly supported, so it's not exactly a commie position as one person raged at me. The fact is, my intent is never to purposely irritate anyone, but these days people get triggered far too easily. Regardless, my plan to continue to create videos that I feel are important and educational, even if someone's feelers are hurt by the data I share because it doesn't align with their desired worldview. Fortunately, there are a ton of channels on YouTube out there, and people are free to watch or not watch whatever they want. It's kind of like investing. If you want to invest in tobacco stocks or defense stocks or Disney or pork bellies or Bitcoin or whatever, then go for it. If you want to boycott a company for whatever reason, then go for it. Spend your money and time however you want, and don't let someone else dictate what you do. If you choose to let your morals and ethics guide your investing, great. If your North Star is total returns above all else, then great. Now, that doesn't mean you shouldn't be open to evolving your stance on things, but you also don't need to change if it doesn't make sense to you. My hope is that we all get to the point where we can disagree about things without freaking out. I mean, these days it seems neither party respects the other, and too many have forgotten that, in the US, we're all still Americans. Having a different viewpoint shouldn't make someone your enemy. I feel lucky to have close friends on both sides of the political spectrum, as it's shown me that we can still get along and respect each other, even when we don't always see eye to eye. Specifically, I have 2 close friends who are solidly on the right and 2 others who are firmly on the left. At the end of the day, my personal goal is to help people, no matter where they live or which political party they align with, and my message is to invest wisely for the long term. Moving on, let's end this episode with some of Warren Buffett's final advice that he shared at this year's annual Berkshire Hathaway conference, where he announced he was stepping down as CEO but would still remain the chairman. Take a listen.
You know, who you associate with is just enormously important, and don't expect that you'll make every decision right on that. I mean, but you are going to you're going to have your life progress in the general direction of the people that you work with, that you admire, that become your friends. I mentioned a few fellows that have died in the last couple of years. Well, all of those people were people that you know, if we were working together on something 1/10,000th the size of Berkshire, I mean, they'd be the kind of people you'd choose. They're people that make you want to be better than you are, and you want to hang out with people that are better than you are and that you feel are better than you are, because you're going to go in the direction of the people that you associate with, and that's something you learn, and of course you learn it late in life. It's hard to really appreciate how important some of those factors are until you get much older.
That's great advice, and I've seen firsthand how the people I spend the most time with inevitably influence who I become. So if I've influenced you, or if you're just feeling kind, then please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to shout out my newest Patreon aristocrat, so thank you goes out to ShawneeBoy86, who just signed up. And as a way to show my gratitude to people who leave really nice comments, I'm going to shout out 10 subscribers who've done just that. So thank yous go out to Carpenter, DrammyXX, James Burrows 3602, New York Nick 716, who's left a bunch of nice comments over the years, Pig010, who've mentioned they're from Australia, Riv8185, Robert Craven, who's left me multiple nice comments, Ross Chasen 744, Sode Story, and the Gordy Pig, who's left a ton of nice comments going way back. I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 85 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.